Citing a recent surge in job growth and inflation, Federal Reserve Chair Jerome Powell plans to tell Congress Tuesday the central bank will likely raise its key interest rate higher than anticipated and could resume larger hikes after slowing the pace in recent months. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated, Powell said in prepared testimony he is set to deliver before the Senate Banking Committee at 10 and the totality of the data and to indicate that faster tightening is warranted. We would be prepared to increase the pace of rate hikes once peak rate is reached, he said. The Fed will likely maintain a restrictive stance of monetary policy for some time, signaling that rate cuts aren't likely this year even if the economy weakens as expected. Some trouble for auto loans. On the heels of the pandemic, borrowers with low credit are falling behind on car loans. Tesla prices fall. Buying a Tesla just got cheaper. Company offers another price drop on multiple models, Powell added. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Last year, job growth, consumer spending, and inflation all slowed, providing evidence that the Fed's historically aggressive interest rate hikes were working to ease consumer price increases. Fed officials raised the federal funds rate by 4.5 percentage points the past year, the sharpest rise since the early 1980s. The central bank, in turn, reduced the size of its rate increases to 0.5 percentage point in December and 0.25 point in February after 4 straight 3/4 point bumps. But in January, the economy created a huge hit of 517,000 jobs. Consumer spending rose 1.8% on a solid basis. And inflation has risen more than expected,